How do you invest in commercial real estate without becoming a full-time analyst? How do you know if an investment fits with your property portfolio? In this video, I'll show you 3 ways you can use to analyze real estate investments for solid returns and to reduce your risk. We're talking real estate returns today on Let's Talk Money. Joseph Hogue with the Let's Talk Money channel here on YouTube. I want to send a special shout out to everyone in our community. Thank you for taking a part of your day to be here. If you're not part of that community yet, just click on that little red subscribe button. It's free and you'll never miss an episode. Now, we've spent the last 2 videos talking about one of my favorite new types of real estate investments, those online REITs. These professionally managed funds seek to hold a diversified portfolio of properties and pass cash flow on to investors. You'll remember that listed REITs are easy to buy because they trade like stocks, but they're also difficult to follow and share prices are more volatile than you'd expect from a real estate asset. Since online REITs are closed funds, the price isn't as unpredictable as REITs. Plus, while the funds are still diversified, they hold fewer properties, so it's easier to keep track of quality. Now, I want to show you how you can analyze individual commercial real estate properties, their place in an online REIT, and how it fits with your portfolio. We'll start by looking at 3 things to watch when analyzing a property, and then I'll show you an example with a property in the Streetwise First REIT Office Real Estate Fund. Now, it's going to be important to remember in all this that even though you're looking at an individual property, your goal is to find how the properties in the REIT fit together and how everything fits in your overall real estate portfolio. Combining listed REITs, online REITs, and even direct property ownership means filling those gaps in property type, region, and your own constraints on time. If you're managing your own residential real estate, you probably don't have a lot of time to manage a lot of commercial properties as well, but you still need those properties to smooth out the risks in your rentals. So when you're looking at an exchange-traded REIT or an online REIT, while you're analyzing the investment value, also make sure that this group of properties is rounding out your portfolio. But it all has to start with the investment. It doesn't matter how well a property fits with your portfolio if it's a bad investment. Now, I can't make you a property analyst in one video, but what I can do is give you 3 places to look that are going to be critical to the success of a commercial property. It's these 3 things that I always looked for immediately when analyzing a deal, and it's here that you'll be able to spot the flaws in bad investments. First is going to be tenancy. If you've owned residential rentals, you know how important it is to have good tenants. Good renters can make real estate investing nearly passive income, while bad tenants can make your life a living hell. It's no different with commercial real estate properties, and there are a few things to watch for to judge the quality of tenants. Do cash flows rely on one or a few tenants for the majority of rents, or is it a more diversified mix? Most properties are going to have an anchor tenant or 2 that pay a majority of the rents, but watch out for properties that rely almost exclusively on one tenant. What's the mix of tenants by sector? Are all the tenants in the same line of business in the same industry? Even if all the tenants are for office space, if those companies are in different sectors, then you'll be better protected against hard times in any one part of the economy. Also, what's the mix of property type? Are the cash flows all from office space or from retailers? Now, you can't get too caught up in this one because most properties are almost all retail or office or residential, but a few mixed-use properties add another level of diversification. What's the financial health of the anchor tenants? Now, you don't need to be a financial analyst or look over financial statements of all the tenants, but you don't want to jump into a property where the most important tenants are already facing bankruptcy. Finally, what are the lease terms for anchor tenants and then lease terms on average? How much time is left in the lease for tenants and what are the lease rates compared to market rents? Leases expire, but it's good to know that you have at least a few years of stability and rents that make the property attractive. Next is what I like to call a sanity check on financials and cash flow. And if there's one place where investors fail in their due diligence or just outright avoid, it's here with these financials. I get it. Opening the financial statements to a property or a fund can seem like opening that 9th grade algebra book all over again. My son tells me that they're teaching algebra in 7th grade now, so behind the times, but you get the idea. You don't have to be an accountant to invest in commercial real estate, but you do need to catch some of these glaring problems with some properties. You're just looking for a few numbers, things like rents, expenses, and cash flow to make sure management isn't being overly optimistic on projections. That's why I call it a sanity check. You'll start with rents or gross rents. Now here you'll make a little bit of a judgment call from your analysis of tenants. Weaker tenants might mean you reduce rents a little for potential vacancy. Then you look at the property expenses over time if they're available, or you can compare them with expenses for similar properties in the area. This should include an estimate of insurance and taxes as well. So rents minus expenses is going to give you something called the net operating income. Now this is where the rubber really meets the road in real estate investing. This is where you'll be able to calculate a cap rate to tell you if the return on the property is good for the market and where you'll be able to find cash flow after debt payments. Your last check on the property is going to be on that projected price and cash return. How much are you going to see from the property price returns and how much from annual cash returns? Now, a lot of this is going to come down to your check on the financials, but it's what is ultimately coming down to, right? So it should be its own step. For the potential price return, you can look at market rates for similar properties and the cap rate. Now, the cap rate is just the net operating income divided by the price, so a percentage return on the investment. Is the cap rate higher or lower than the average for property types in the market? Looking at similar properties in the area, you want to find an average price per square foot and average rent per square foot as well. You also want to look at growth in these prices over the last few years. This is all going to give you some sense of any potential price return in the future. For looking at the cash return, you can check management's numbers like debt service and expenses. How much is management estimating it can return to investors every year, and is this really realistic given regular expenses plus maintenance? Now let's look at putting all this in practice. We'll look at the first street office REIT offered by Streetwise as an example, and specifically at the Laumauer property. This is a Class A office park in Sunset Hills, Missouri, comprised of 3 buildings with nearly 300,000 rentable square feet. Now, as a disclosure here, the numbers I have are from the most recent public filings and the SEC website for the company. So make sure you check Streetwise for updated info. I'll leave a link to that in the description below. So Laumauer is leased to 25 tenants, most with solid credit profiles and across sectors including insurance, technology, retail, and healthcare. 40% of the space is leased to Panera Bread for its national headquarters, with New Balance Athleticwear leasing another 14% of the buildings. The property has a tenancy rate of 99.4%, which is extremely high, and tenants have a weighted average lease term of 5.5 years remaining. I've seen good commercial properties that were only about 90% leased, so to be nearly fully occupied is excellent. Core tenants Panera and New Balance both have until 2024 on lease terms, so that's really more than half the property leased up for the next 6 years. The property was acquired for the Streetwise online REIT for approximately $44.4 million, or about $153 per square foot. Now, 2017 net operating income was around $3.95 million, so that's a cap rate of 8.9% on the price. Just over half the purchase was financed with a $24.6 million loan on 10-year terms and at a 4.4% fixed rate. So based on this, management has been able to pay a 10% annualized yield since inception in September 2017. I like that the tenant mix is spread across 25 companies and diversified in different industries. The 2 core tenants occupy more than half the space, but both are financially healthy and have more than 5 years left on their leases. The St. Louis market is huge. The city is the 18th largest metropolitan area with a population of nearly 3 million. It serves as the headquarters for 17 Fortune 1000 companies, and unemployment of 3.4% is lower than the national average. According to Gershman Commercial, office rates for Class A buildings ended 2017 at about $27 per square foot, which is well above the rent paid at Laumauer core tenants. Panera is paying about $24 in base rent, and New Balance pays about $22.34 per square foot. Vacancy in South County, the submarket within St. Louis, was 9% at the end of last year, and only Central Business District in North County had sizable vacancy, so there isn't a lot of empty office space weighing on rents. Rents across the area rose 2% from the prior year and have been rising generally, while vacancy rates have been falling since 2016. So some very good market dynamics here. That cap rate of 8.9% is very good. I think a combination of solid rents, low expenses, and a low purchase price on the property. From base rents paid by anchor tenants, rents look like they could be raised significantly as leases expire, so that should help support the cash flow as well. Now, investing in online REITs makes everything easier because you can analyze the individual properties in a fund. You can track new acquisitions and developments to make sure it fits with your portfolio and the kind of quality that's going to support those solid cash flows in return. It's one of the things I like about online REITs versus those exchange-traded REITs. With an exchange-traded REIT, you might have hundreds of properties in a fund and more added every single month. That makes it impossible to track for the individual investors, so you're made to completely rely on the fund manager. Now, that's not to say that I don't invest in listed REITs. They have their benefit as well, including the ability to buy and sell quickly. But just know that you need to balance your portfolio with both those online REITs and listed REITs. There is no other asset like real estate. Stocks come and go. General Electric, the last original member of the Dow, was dropped this year. Bonds are safe but offer very little chance for growth. I've been an active real estate investor for decades and have watched the opportunities evolve from direct ownership to listed REITs and now onto those new online REITs. Building your wealth while avoiding the risks in each real estate strategy means combining them for a portfolio that grows. Check out Streetwise in that link in the video description below for that online REIT part of your portfolio, and make sure you watch the other videos in the series to learn more about this new revolution in property investing. We're here every Monday and Wednesday with the best on beating debt, making more money, and making your money work for you, so click subscribe to join the community. If you have a question about money or investing, scroll down and ask it in the comments and we'll get to it in a future video.